Hey everyone, and welcome to Talk Tickers. So, on October 17th, Havells India dropped their Q2 earnings. And on the surface, they look pretty good. But the market's reaction told a completely different story. So in the next few minutes, we're going to dig in and figure out exactly why a profitable quarter got such a flat reception.
So what was the market's immediate verdict? After their earnings call, the stock moved a grand total of nothing, 0.0%. Just flat. Now, for a company as big as Havells, that kind of indifference, that's a statement all by itself. And that, right there, is the core question we're tackling today. The headline numbers were solid. Profit was up nearly 19%. So, why the big shrug from investors? It's a puzzle, and we are going to solve it right now. Okay, here's how we're going to break it down. We'll kick off with that muted market reaction and the top-line numbers. Then we're diving into the real heart of the story, this stark difference between their booming cables business and the struggling Lloyd segment. We'll also cover what management had to say, and of course, I'll wrap it all up with our rating for the next call. All right, first up, let's get into the numbers. We're going to peel back that first layer and look at the headline figures. So, consolidated revenue for the quarter came in at just over 4,700 crore. Now that's a 5.3% increase year over year. It's growth, sure, but let's be honest, it's not the kind of explosive growth that really gets the market fired up. But this is where the story gets really interesting. Their profit after tax, or PAT, jumped a much healthier 18.9%. And look, anytime you see the top line, the revenue growing at just 5%, but the bottom line, profit, growing at almost 19%, you know there's more to the story. You got to dig deeper.
So what did that translate to? An earnings per share of 5 rupees and 9 paise. On paper, that profitability story looks really strong. But on paper is the key phrase here.
So how did they pull that off? Well, a big chunk of that profit growth, it came from a 45 crore one-time gain from selling an asset. If you strip that out, suddenly the profit growth looks a whole lot closer to that 5% revenue growth. The market is smart. It always sees through these one-time events, and this is where our puzzle really starts to come together.
Okay, now for the real story of this quarter. Because underneath those big consolidated numbers, Havells was basically operating as two completely different companies. It was a tale of two businesses, one that was absolutely thriving and another that was seriously struggling.
And believe me, the divide was stark. You had the cables division, the absolute star of the show, up over 12%. But on the flip side, the consumer business was really weak. Electrical consumer durables was down a bit, but the Lloyd business, it just fell off a cliff, dropping a staggering 18.5%. So why the huge split? Well, for the cables business, everything was going right. They had an easier comparison to last year, and commodity prices were working in their favor, which really helped margins. But for the consumer side, it was the exact opposite story. A shorter, weaker summer meant lower sales. When that happens, your factory costs get squeezed, and to make matters worse, they had to offer a bunch of discounts just to clear out all the inventory sitting in the channel. Just a really, really tough quarter for their B2C business.
So you've got this backdrop, right? Strong B2B, weak B2C. And the big question is, what did management have to say about all this? Let's break down the key themes from their commentary and the analyst Q&A session. The chairman and MD, Anil Ray Gupta, he didn't beat around the bush. He put it very plainly, saying the core issue was weakness in summer products because of a shorter season and a huge overhang of channel inventory. That quote right there, it really frames the entire challenge they were up against. Diving into that Q&A, a few key things really stood out. First, management basically promised that this whole inventory mess will be cleaned up by the end of Q3. Second, they're really pinning their hopes on a strong festive season, and they mentioned seeing some positive signs from rural demand. Third, a recent GST rate cut on things like air conditioners is seen as a nice little tailwind. And finally, they kept coming back to the fact that their core B2B business is still very strong, and that they're keeping a super tight lid on costs.
All right, let's pull all of this together. So what does it all mean? What should we be watching for? What's our rating? And hey, is there even a trade here? This is the next call.
Looking ahead, there are really 4 key things that investors are going to be focused on. Number 1, is that festive demand actually going to show up? 2, can they really turn the Lloyd business around this year? 3, can the super profitable cable segment keep up its strong performance? And number 4, if demand does pick back up, can they translate that into even better profits? The answers to these questions are what will drive the stock from here on out.
So, where do we land with our rating?
We are calling this a market perform. And here's why. The strength in their B2B cables business provides a really solid floor for the stock. But on the other hand, the major inventory problems in the consumer business act as a ceiling. You've got this floor and this ceiling, and the two sides are just perfectly balanced. Which, when you think about it, is exactly why the market had that 0.0% reaction in the first place.
Okay, this brings us to our trade idea for the next call. Now, if you believe that this split, this divergence between a strong industrial business and a weak consumer business is going to continue for a little while, then the play here could be a pairs trade. Here's how it works. You go long on Havells, essentially buying into its best-in-class, stable cables franchise. But at the same time, you short a pure-play competitor, one that's way more exposed to all the pain happening in consumer durables. What this does is it isolates your bet. You're not betting on the whole market, you're betting specifically on Havells' B2B strength against the sector's B2C weakness.
So when you boil it all down, the story for Havells is like this powerful industrial engine that's being forced to pull a very, very heavy consumer carriage. The big question for next quarter is simple. Can they finally lighten that load? Or is that heavy carriage going to start to slow down the engine? We'll find out on the next call. And, as always, please remember, this is not financial advice.